All right, in this lesson, we're going to talk a little bit about planning the audit and things that should go through your mind as you're planning the audit. These are beyond kind of the things that we've talked about before, in which we're talking about prior to actually getting started, what are the things that we need to think about and do. This is now, we've kind of, all right, said, yes, we're going to do this audit. These are the things that we should think about but prior to really completing the audit and getting through with that audit. So these are the first things that are done after the client accepts the engagement letter and the engagement letter is returned to us. The first thing that we need to do is assess business risk. Now, we assess business risk because we also want to avoid audit risk. And so remember that audit risk tells us that what's the risk that we're going to give an inappropriate opinion about the financial statements when something else should have occurred. So we give a clean opinion when it should have been not clean, or we give a not clean opinion when it should have been clean opinion, which usually doesn't happen, but it could. So what's the risk of that and the things that we need to be looking at in order to mitigate that risk? And so that's one of the first things that we're going to figure out and try to think about is what risk does the business have and how does that risk hurt or help our audit, in which provides us an opportunity to give the wrong opinion about how their financial statements are actually prepared. The second thing that we might think about is establishing materiality. Now, we haven't really talked about materiality much, but basically materiality is this. If I were to give a college student $100 and they lose it, they would be mad. But if I were to give a millionaire $100 and they lose it, it's not the end of the day. For the millionaire, $100 is not material. For the college student, the $100 is material. So materiality is the ability for someone, the user of the financial statement, to make a change in decision based on that material amount. So as an auditor, we're looking at what is material to the financial statements, and we want to establish materiality. Why do we establish materiality? We establish materiality because of the cost-benefit principle, in that do we get enough benefit out of something if we audit the entire books versus if we audit what would give us a 95% assurance level that all the books are correct? Yes, there's a 5% risk that they could be wrong, but that 5%, in order to get to that 5% risk, it would cost 5 times as much to gather the evidence. Is it worth it at the end of the day? Is it material at the end of the day? So we want to establish materiality in that planning part so that we can start looking at all the data that we need in order to figure out how we're going to approach this audit. Then we'll also want to consider multi-locations. When we talk about multi-locations, we're now in an age where a lot of companies are multinational, multi-location institutions. And so we need to figure out, how does that impact our audit work? Do we need people from outside the U.S. to do the audit of their smaller counterparts? Do we need to send our audit team on a travel spree to make sure things are up and up? Or do we need to send a team out to look at inventory at different locations throughout the, let's say, United States? So that's very important that we consider multi-locations, because everything is not just at the headquarters. For instance, if you're running a construction company, you might want to visit a couple of the construction sites in which your construction company is doing work to assess whether or not the assets are truly theirs and actually are present at these locations. If you're running a retail store throughout the United States, you might decide that you want someone to go in to a very sparse amount of them to get a sample size of how the inventory looks versus what they have on their reports. And so you might send a crew out there, or you might send someone who's locally there to complete that inventory observations. But we want to consider those multi-locations, and as we consider those multi-locations, how do we address those risk issues that might happen if we don't look at them, and if we don't go there and we don't check it. That doesn't mean that the actual engagement team is actually going there. We can have other people that are already there go there to check on things, or it may be better for the audit team to go. It just depends on the engagement at the end of the day. Then we need to assess the need for specialists. So for instance, a lot of auditors aren't IT people, and a lot of accounting information is IT based. And so we may need to call in IT specialists to go in and check the internal controls of the IT system from a very data level to make sure that data that goes into the accounting program is spit out on the financial statements appropriately, properly, in the right manner, correctly, added right, and all of that. So in order to do that, we might need some specialists. In addition, derivatives is something that most auditors don't understand, and so we may get someone who is a derivative specialist that will come in and do the work of the derivatives and then issues a report to the audit team whether or not to confirm or deny those tests that that derivative specialist did. So we might need to look at specialists in order to make sure that we're doing the appropriate audit procedures for that client. We also want to consider violations of laws and regulations. Now, this one can come in terms of financial or non-financials, but we also want to, this is what my partners did all the time. They would pull out the Wall Street Journal, they would look through the Wall Street Journal to see if one of their clients was in there, and then if one of their clients was in there, they would go deeper into why that client's in the newspaper. It may be for a violation of some securities law, and so obviously we need to know that. It may be that they're getting fined with a penalty from the EPA. We're going to want to know about that. Maybe they're in a lawsuit or a pending lawsuit. We may want to know about that. So consider the violations of laws or regulations or things that might hamper the client. Some of it may be public, some of it may be easy just as a Google search. Other times it may be talking to people within their group like attorneys to figure out what's going on. We also want to identify any related parties within the organization as well as within that may have a independence issue. Hopefully we've gone past that independence issue, but we want to identify any related parties and understand how that will affect our audit. Now, this next one, I say this very lightly, however, knowing that auditors can only do certain other services for their clients, this may not be an option for auditors. But we may decide or consider any added value services that we can provide to the client as we are doing this. Now, I say this with caution. If this is an independence issue, then we cannot think about this. But if we are a real small company and we're auditing a client that we don't need to worry about audit independence issues, then maybe we need to see if there's other services that we can provide the client that doesn't impair our independence judgment. So this more is a sales thing than it is kind of the audit world thing, but we should think about that because we always want to grow our companies. But again, this may be not appropriate if we have independence issues with this client. And then lastly, we need to document the audit plan, the strategies, and prepare the audit program. Now, we haven't really talked about this, but really what it comes down to is how are we going to audit the client based on the information that we're starting to receive. Now, we might not have all the answers, but we do have a good guide of how we're going to do the audit, because when we audit cash, we always pretty much audit cash the same way. And so we want to make sure that we can go ahead and put those plans together. Now, an audit program is something new that we haven't talked about, but an audit program is basically the program of auditing that client. And so the senior or the manager in charge of the client will go ahead and prepare that audit program, and that program is what is used by the entire engagement team to audit the client. Now, the audit program usually has a few checklists in there. Checklists are ways that we try to control the way that the audit is being completed, and so those are very vital in that audit program. So it's very important that we consider the audit program and how we're going to audit the client. So again, to kind of recap the things that we've been talking about in this video, we're talking about planning audit. What are the things that we need to do to plan the audit as we have now become the auditors for this client? Well, we're going to need to assess business risk so that we can also assess audit risk at the same time. We need to establish materiality and making sure that materiality is appropriate for the client based on the financial information that we've already gathered in our pre-client phase. We also want to consider multi-locations. If they have multi-locations, do we need to pay a visit? Does another office that is still within our umbrella need to pay a visit in order to make sure that we have all of our bases covered? We also want to assess the need for specialists. From the IT standpoint, auditors are not IT people. So do we need an IT person to go in, check their softwares and processes that are IT-based related and make sure that they're working appropriately and to the standards that we expect them to? Consider any violations of laws and regulations. How does those impact our own clients, and how do those impact how we complete this audit at the end of the day? Identify any related parties to the audit, making sure that we identify them and know how that impacts our audit as well. considered any added value services, understanding that it could be an impairment of independence, and therefore we may not be able to offer that to their client. And then document the audit plan, strategies, and prepare the audit program to make sure that we have a plan on how we're going to audit this client. So again, this really has to do with just the audit plan and how we assess the plan and how do we go with that plan with those checklists at the end of the day. So again, kind of give you a recap, we're really talking about what are we doing now that we have accepted the client and what we need to think about as we're planning that audit. So in the next lesson, we're going to talk a little bit more about what things we need to do. We'll talk a little bit about materiality, and we'll talk about some of the types of audit tests that we're going to be doing to give you an idea of what's going to happen as we go further and further in your audit education.